Hi there. I'm Charles Goddard. If you're here, it means you've received book one of my basic trading series by now, and you've got a little profile on who I am, so I don't see any need to go back over that. So first of all, my job, I feel, is not to demonstrate to you how much I know. It's not to demonstrate to you just how much material is covered in these five modules, this training that I've got, that I'm hoping to persuade you to partake in. My job is to convince you that you can do it, that a lot of people, if they are the rank beginners I'm looking for, or they're people who are trading but they're struggling, they're not getting anywhere with consistent results, they one step forward, two back kind of thing, then that's my task to persuade you that you can turn that around for yourself with a little effort, with a little work. Yep, sorry, there is going to be some work, and with the basic and simple tools and methods that I will teach you. So let's start with the setup, and so if you will tap your spacebar, we'll move to the next slide. Okay, so the first thing I want to show you in the setup is what a chart looks like. Okay, so this is what you're looking at here is a chart of Apple, and this is pretty close to the setup I use. So it stays pretty clean. It's not got a bunch of indicators and lines and things on it. Uh, Price movement is what we're after. Price movement is what's important, and what I teach is that you stay close to the meat of the market by staying as close to the price. In other words, every time you add an indicator on top of an indicator on top of an indicator, you are moving further and further away from the price action. So number one, first of all, this chart was generated from a free site, stockcharts.com. You can go there. You can go to Yahoo Finance. They do free charts also. And because I keep my tools basic, my oscillators and indicators basic, like the items that I teach you as you get into my course, you can find either on your platform at your account, or you can find it for free on the internet. So the only thing missing off of this particular chart that I would use would be the RSI, and I haven't included it because at this point, I will show it to you in the future. Uh, the reason I haven't included it is because if you looked up the RSI, you would see how people use it, and I use it in a quite a different manner, and I think a far more useful manner. So that's a little lure for you to come along with me on this training and find out what I'm on about. All right, so what we've got in our setup here is we have several choices of charts, as you will know from the book or the books, and the one that I like as a starting point is the candle chart. So what you've got is a series of what looks like candles. Candles were developed by the Japanese several hundred years ago. They were rice traders, and the information on these candles is quite amazing, and we dig into that quite a bit in the course. Now the lines, the little thin lines that you see, are what's called moving averages, and I use those simply to smooth out the price. The price can jump up and down, but I'll show you how moving averages, trend lines, etc., help us to smooth out that price, so we're not reacting to every little move, every day-to-day move in the price. The line above is called the ROC. You could find it as MOM. They are both stand for momentum, and essentially it's a reading of the energy that's driving the market. So you can see in about the middle of the chart, you can see a high in the ROC, and then as that price declines, you see the price of Apple rising till the high point in Apple on the right hand side does not match a high point in the ROC. I will teach you how that divergence is giving us a warning, which as you can see proves to be accurate as the price then begins to decline. And I will show you how to pursue that a little more and get your timing a little tighter about when to get out of your trade. Okay, so let's move on to the next slide, where I show you a very simple trade. Let's go. All right, so actually I got a little ahead of myself there on that last slide. I'm not going to show you a little trade, sorry. What I'm going to show you is our setup, and what I've done is I've put clever yellow circles around three key points on this slide, and I want you to use the thin moving average lines, and I want you to figure out what the trade would be if we were using the moving averages, the thin colored lines, to generate our trade. Now remember, our goal here is to take us out of the equation. That's you and me. We are the weakest links if we are allowed to think about our trades. So we want to be as objective as we can. We want the price to dictate to us when we get in and when we get out. We don't want it looks like and it should have's and all of those things. They are now taken away from our thoughts, because we've got a very precise way of deciding whether to get in. We've got a very precise way of deciding where to protect ourselves, and I want you to note down where you would do these things, where you would get in, where you would protect yourself, where you would get out. Now, I don't expect you necessarily to come up with the right answer, but I want you to think a little bit, and I want you to take a look and see if you could come up with those things. And the next video will be at your door in a couple of days, and we're going to answer these questions and dig a little deeper into where the trade would have happened, where we would have protected ourselves, where we would get out, and also what would be our overall risk management along the way. So I'll see you in the next video. Keep an eye out for it, and thank you for listening so far. Bye now.